Hello and welcome back to another series of lecture videos. In this series we're going to deal with Chapter 3, and in Chapter 3 we're going to be talking about the accrual basis of accounting. So in this video what I want to do is kind of discuss what exactly is meant by accrual basis. I want to compare it with the cash basis of accounting, and we're going to get into FASB, right? Specifically, we're going to get into GAAP and how FASB issues the generally accepted accounting principles. So specifically, within GAAP, we're going to talk in this video. We're going to talk about revenue recognition as well as expense recognition. So let's just jump right into it. Hopefully, by the time we complete this video, you should be able to explain the accrual basis of accounting, and you should be able to compare it with the cash basis of accounting, specifically when we're talking about revenue and expense recognition. So why do we use accrual accounting, right? Well, we have to. It's required by GAAP. And what accrual accounting does is it's a way to measure and report our economic transactions without necessarily dealing with cash. Okay, so what accrual basis of accounting does is it allows us to measure and report revenue and expenses based on the transactions that we have, and that recognition has absolutely nothing to do with when cash is paid or when cash is received. Okay, so the two main principles that really establish or solidify us using this accrual basis of accounting is the revenue recognition principle and the expense recognition principle. The expense recognition principle we also call the matching principle. So as we go through this discussion and you hear me say matching principle, I'm really talking about expense recognition. Okay, so let's look at a few examples of revenue recognition. Okay, we're going to look at that under the accrual basis of accounting, and we're going to look at it under the cash basis of accounting. Now, I probably should have said this in the beginning, kind of my little disclaimer. We will not get away from debits and credits. So if we're not understanding those, it's imperative that we go back and read through Chapter 2. Memorize debits, credits. How do I increase an asset? How do I increase revenue? How do I increase a liability? How do I decrease those through debits and credits, right? If you don't know that, it's imperative that you go back and, again, work on memorizing that, okay? So let's look at the first transaction that we have here. And under the revenue recognition principle, we say revenue is recognized when it's earned. Makes sense, right? But when we're looking at the accrual basis and the cash basis, when is revenue earned becomes kind of a tricky thing, right? Under the cash basis of accounting, we say that revenue is earned at the same time cash is paid or cash is received, okay? So, under the cash basis of accounting, we make a sale, okay? We make a sale, somebody gives us cash. Based on the cash basis of accounting, we have revenue. So to book that transaction, we're going to debit cash, credit sales revenue, okay? Nothing really new there, right? The whole cash basis of accounting just says cash is the determinant of when revenue is recognized, okay? Under the accrual basis, doesn't matter when we receive cash. Cash is not the determining factor of when revenue is recognized. So let me give you two examples here. Under the accrual basis of accounting, it is possible that cash could be received after revenue is recognized. Well, what do you mean by that? Well, let's say that, let's just keep it simple. Let's say that we own a farm, right? We sell pumpkins. It's kind of cool, right? And let's say that Giant Eagle calls us and says, hey, I want to buy pumpkins off you so I can sell them in my store. We say, hey, great. How many pumpkins do you want? So the truck or Giant Eagle calls and says, we want 100 pumpkins. Perfect. We put them on a truck. We send them to Giant Eagle. We did not get cash yet. We didn't get paid, right? We have no cash, but we still have revenue. Okay. Why? Well, because we provided Giant Eagle with a product. We expect to be paid, right? So we have an asset here. We have the right to receive payment. That's an accounts receivable. So anytime under the accrual basis of accounting that we have cash coming after revenue recognition, we're going to debit accounts receivable. We're going to credit sales revenue, okay? There's another instance where we may not have revenue, but we get cash. What do you mean by that? Well, let's say, for example, that we're same scenario, right? Giant Eagle sends us a check for $100, and they say, hey, next week I need you to deliver 100 pumpkins. Okay. Do we have revenue? No, we do not. Because under the accrual basis of accounting, cash is not the determinant of when we recognize revenue. So in this example, what are we getting? Well, we're getting cash. So we're going to debit cash, but what are we going to credit? We cannot credit revenue at this point because we didn't earn revenue, okay? What we can do is credit a liability. That liability account is called unearned revenue, okay? We received cash. We have an obligation to provide Giant Eagle with 100 pumpkins, okay? To book that, we can't hit revenue. We have to hit a liability account called unearned revenue, okay? Try not to get confused because you see revenue, you see sales revenue, then you see unearned revenue. Unearned revenue is always a liability. It means that we have to do something, provide a service, provide a product in order to recognize revenue. We haven't done that yet, so we have a liability on our hands, okay? When we're talking about the matching principle or expense recognition, basically what we say is expenses are incurred to generate revenue, right? And think about it, that makes sense. We have to pay our employees to generate revenue to provide a service. Let's go back to the farm, right? We have to pay people to, farm, right? Plant the pumpkin seeds, maybe, water, fertilize, whatever we do on a farm, okay? We have to buy seeds and material and all that other good stuff. So what we're saying under the matching principle is that any expense that we incur to generate revenue need to be matched in the same period that that revenue is earned, okay? Again, with accrual accounting, cash payments can either occur before, after, or at the same time of expense recognition, okay? Let's look at some examples, and I think this might become a little clearer. Okay, so let's think about it this way. Bear with me here. We're going to do it on the fly. Okay, so let's say, for example, that, and let's say that we buy supplies, right? We buy supplies to grow pumpkins, right? Seeds, whatever. Okay, so we have the cash that we pay for those, and we'll say we're going to book supplies. Okay, this is when cash, or I'm sorry, this is we're going to recognize at the same time. Okay, supplies expense. So we get cash, or we pay cash for $100 for our supplies. we're going to recognize that expense, okay? A lot of times, this cash payment is going to come either before or after the recognition, okay? We're going to see more examples of those a little later, but I just want to give you kind of a taste of what happens when they're at the same time, right? We spend cash, we immediately recognize the expense. So remember, which of the following is the primary principle that's underlying accrual accounting? Well, it better be revenue recognition, right? Why? Because the main principle that underlies accrual accounting has to do with that recognition, right? That recognition principle. Okay, so let's look at the adjustment process. What exactly is the adjusting process? Why do we do it? Well, we've already studied accruals, right? We know that under the accrual basis of accounting, recognition and cash flow are totally different, right? Two totally different things. Cash, or the receipt or payment of cash under accrual basis, does not dictate recognition, okay? So we have to do some adjustments, okay? So what we see here is an unadjusted trial balance. All a trial balance is, regardless if it's unadjusted, adjusted, closing trial balance, it's all the same thing. It's all a list of accounts with their balances. Okay, so we see here that we have a debit column and we have a credit column. So we go through and we list all the accounts that are in our accounting records: cash, merchandise inventory, prepaid rent. We haven't seen that yet. We'll talk about it when we get into adjustments. Equipment, accounts payable, notes payable, common stock, sales revenue, expenses. So we list all our accounts and their balances. So if you remember last chapter, I kept regurgitating or kept spewing out, the debits and the credits of assets, liabilities, and owner's equity, right? Cash is an asset. It increases with a debit, decreases with a credit. Debit is the normal balance side. So we have to know those normal balance sides. Once we prepare our unadjusted trial balance, we have to total everything up, right? Debits and credits always have to equal. And that's what the unadjusted trial balance does for us. It makes sure, or it ensures, that debits and credits are equal, okay? Keep in mind, just because they're equal doesn't mean we did everything right, okay? It's possible we could have missed a transaction, actually didn't book what we should have booked, right? In that case, the trial balance will still balance, but at the very least, it has to balance. So we have a number of adjustments here, right? We have 4 actually that we're going to look at. We have prepaid expenses and unearned revenue. We have accrued expenses and accrued revenues. So what's the difference between these? Well, prepaid expense says that we are allocating previously recorded assets to an expense. Okay, let me give you an example of prepaid expenses. Let's say, for example, that we're going to go into business together. We're going to be accountants. I know we got a lot of psychology majors, but let's just, let's go with that, right? We're all going to be clinical psychologists. Okay, we're going to open up an office and we're all going to see clients. Well, first thing we do is we say, you know what? Let's pay our rent in advance, right? Let's say we pay $1,000 a month for rent. It's January 1st, 2020. We'll start this next year. And let's say that we shell out 12 grand and we give it to the landlord. And we say, here you go. Here is a full year rent in advance, okay? So we have the asset, which is our prepaid rent. That's an asset to us, right? Because it's a resource that we can use, okay? Under accrual-based accounting, just because we paid cash, we do not recognize the expense, right? Because of the matching principle, we need to match up the expense of each month's rent with the revenue that we generate within that month, okay? So this is an example of a deferral, right? Prepaid expenses and unearned revenue are examples of deferrals, okay? And basically what we're saying is cash comes first, then the recognition comes, right? As with prepaid expenses, we paid cash for a year's worth of rent, but we didn't recognize that rent expense yet. We will as we go through the year. Unearned revenue. This is where we allocate previously recorded unearned revenue to earned revenue. Okay, well, what do you mean by that? Well, we saw that example in the previous slide where somebody gave us cash and in the future, we're going to provide them with either a service or a product. In our example, we used pumpkins, right? So what we have here is a liability. Okay, we owe somebody either a service or pumpkins. Previously, we recorded that unearned revenue as a liability. What do once we perform that service, once we deliver those pumpkins to Giant Eagle, guess what? We don't have a liability anymore. We actually earn the revenue. Okay? So again, two types of deferrals we're going to be working with: prepaid expenses, unearned revenue. Those are the two types of deferrals, and under these scenarios, cash comes first, then the recognition comes, okay? Accrued expenses and accrued revenue. Well, hopefully you've guessed, these are the two examples of accruals that we have, okay? Under accrued expenses, what these are when we need to record operating expenses that haven't been paid, nor have they been recorded. Okay, now that might seem a little foreign, right? What are you talking about here? Well, let's think about it this way. Let's say that today, it's what, Friday the 18th, okay? Let's say we need to close our books today, right? We need to close our books and we need to report our assets, liabilities, our equity, our expenses, our revenues. We got to, report those today, okay? Well, we all work together. And guess what? We worked Monday, Tuesday, Wednesday, Thursday, and today, Friday, 5 days, right? We're not going to get paid until Monday, right? Well, we're still going to get paid. We're still going to work and get paid on Saturday and Sunday. Friday, we have to close the books. So what the company needs to do is stop on Friday at the end of the day and recognize and say, you know what? We've incurred expenses, salaries, expenses. The company owes each of us 5 days worth of pay, right? But we still have more time to work and more time to work and later after the period, and we're going to get paid later. So what happens is the business needs to recognize that, we have an expense. We haven't recorded it yet. We haven't paid it yet, but we've incurred an expense. That's what accrued expenses are, okay? Accrued revenue. Here we're saying that we're recording revenue that has been earned, but we have not recorded it yet, nor have we received it yet, okay? Think back to the previous slide that we had when we were talking about revenue recognition. That was the example where we debited an asset, accounts receivable, and credited revenue, okay? These two types of accruals, accrued expense and accrued revenue, what we're saying here is recognition happens first, then the cash payment comes, okay? When we come back in our next video, we're going to talk about deferral adjustments a little more, and we're going to demonstrate how you prepare those deferred adjustments. But before we go, we talked about two very important things here, right? We introduced accruals. We said, what are accruals, right? Well, accruals are required by GAAP, and it requires us as the company to measure and report transactions that maybe cash has not been paid or received yet for those transactions, okay? So we defined accrual accounting. We know what accrual accounting is based on: revenue recognition and expense recognition, or the matching principle, right? We know what they say, right? Basically, revenue, under the revenue recognition principle, we say that we recognize revenue when it is earned. Cash, the cash payment, is inconsequential to us recognizing revenue, under the accrual base of accounting. Cash basis of accounting, hey, we recognize when we get cash, okay? Same thing with expenses. Under accrual accounting, expenses are recognized when they are incurred to generate revenue. So we're matching the expenses with the revenue that we generated in a specific period. Again, this is under the accrual basis. Under cash basis, we say, you know what? Whenever we pay cash, that's when we recognize the expense. Accrual basis says cash is inconsequential to the recognition of the expense. We have to match it with the revenue generated. Okay? And then we talked about the types of adjusting entries, right? We talked about the two deferrals we have, prepaid expenses, unearned revenue, and we talked about the two accruals we have, accrued expenses and accrued revenue. When we come back in our next video, we're going to go through the journal entries, right? Every time we have a prepaid expense, we have to debit something and credit something else. Every time we have an unearned revenue adjustment, we have to debit one account, credit another account. And those will pretty much always be the same. And I'll explain that in our next video.